various pockets doing well at this point in time. And yet we are at stratospheric heights. So should we be scared of heights? Let's ask our market master for the day. Pramod Gumbi, Director Institutional Sales at Ambit Capital, joins us now from Singapore. Good morning, Pramod. Thank you very much for joining us. Would you be scared of these, fairly high levels, which we have notched up very quickly? I mean, 8 or 9% in just the first 20 days of trading in 2015. Is it too much too soon and good to perhaps take some profit?
Yeah, from a short-term perspective, I guess when it happens, such as these last few sessions, that the rally is so sharp, you're always concerned that there's a pullback around the corner. And perhaps rightly so, because remember, while the future looks quite bright from every perspective, be it global liquidity or domestic reforms, the underlying recovery in the economy and more particularly corporate profitability is not there yet. So you don't want to reach a stage where you're looking at significantly rich valuations without a proper recovery in the earnings cycle. So I would think from a short-term perspective, yes, worth looking out for a pullback, but the future looks bright. From a 2 to 3 year perspective, we still recommend buying into these markets.
Okay, so at what levels would you recommend an investor to buy? I mean, do you think that, for instance, private sector banks, do they have to shed a lot of weight before you buy them? Would it be good to buy public sector banks if they shed weight now?
I mean, we've argued that, if you're entering the market with a reasonably long-term view, shorter-term valuations are less of a factor in terms of your overall returns after 3 years. Having said that, I think, yes, the rally in financials particularly has been quite sharp, more so in private sector banks. Private sector banks is where we would perhaps be keen to see a bit of a correction. It's always nice to buy lower. But given the quality of some of these franchises, if it is elusive, that's the sense of timing the bottom of the market, might as well get in and hold on for the long term. Public sector banks we would rather wait on, given there are structural issues where the government needs to pull up its socks and deliver the sort of reforms to recapitalize these banks, if these banks were ever able to be part of the credit growth story in India. So in that case, we would not be in a hurry to buy at these levels.
Okay. Pramod, hi, good morning, and thank you for joining us on the show. I just want to pick up on a point you made a while back where you said that the basis of every rally, as we all know, is earnings growth, and we haven't seen any great recovery in earnings growth. So in a sense, this rally is quite worrying. By when do you expect to see a concrete, growth in earnings, and what are your own estimates as far as Sensex earnings are concerned by the end of this year and next?
I think for a proper recovery in the earnings cycle, we would have to wait for FY17. Remember, at the economy level, there was some bright sparks in terms of recovery in discretionary spending, which is also sort of moderated now. I think the key for the economic recovery remains the investment cycle. And there, speaking to a number of corporates and reading their annual reports, you get a sense that the investment cycle is not going to start with the private sector. It has to be with the government, and I think the government also recognizes that, and hence anybody should keenly watch the budget to see where the government puts its money. The savings that we've got from the fuel subsidies, the crude price fall needs to be deployed elsewhere in terms of infrastructure creation, roads, railways, defense, which will start its own economic activity and then trickle down towards job creation and consumption, and you get into a virtuous cycle. That I would think is at least a 12-month cycle before the economy becomes more broad-based in terms of benefiting from that kickstarting of the investment cycle, and then it starts flowing into earnings of corporates. So I would think the proper recovery in the earnings cycle would not be before FY17.
So what is the biggest risk to this market now, Pramod? Is it to do with the expectations from the budget, or do you think it's global? And what could the extent of the downside be if there is any sell-off that comes by?
The risks gradually are abating. I think one of the risks that we were facing over the last 6 to 8 months was a US rate hike. Now, clearly that's still on the cards, but incremental data and happenings elsewhere, particularly in Europe and Japan, where liquidity has been flush. We don't see the same sort of imperative for the Fed to go ahead and hike rates any soon. It will happen eventually, it has to, but our sense is it's perhaps a bit later than one would have thought, so maybe 6 months ago. So instead of, say, middle of this year, perhaps we're looking at end of this year. That again is not such a catastrophic risk for the Indian markets. There might be some short-term turbulence, as it always happens, particularly with the currency and so on. But from a longer-term perspective, it's not that much of a risk. The key risks remains about our own failure to deliver reforms, structural reforms. I'm saying we're pretty sure that there's a cyclical recovery underway, but that's not what I think the markets are expecting from this government. It's the ability to deliver structural reforms like tax administration, GST, getting to improve the power sector, getting to recapitalize the banking sector. These are the sort of reforms which need to be implemented in a hurry to push up our trend growth rates from 6-7% to perhaps 8% and not. So the key risk remains within the Indian government's hands, and that's something that we'll watch out for. Perhaps a tail risk could be again with the global liquidity coming back into the markets if there is a reversal in the commodity markets, which have been a boon for India. But at this stage, it's not clear if the liquidity will find its way into those asset markets.
Okay. Pramod, what would you look forward from the budget? What would constitute a budget which will make a trader take profit? And what would constitute, an invitation to buy?
I would think, like we've been advocating, the absolute level of the fiscal deficit is not so much of an issue. I think given the stage at which India is and the economy is, the absolute levels, whether it's 4 or 4.5, shouldn't bother so much. It's always been the quality of the fiscal deficit, the skew towards revenue expenditure over capital expenditure in the recent past. If that is reversed, given that we've already had some savings on the subsidies front, if those savings are plowed back into capital expenditure, creation of assets, particularly in infrastructure, that can be a real cracker of a budget to watch out for, and something to excite the markets to take a longer-term view that these assets are being created, and at some stage these assets will start giving value. That's something that will be key to watch out for. That should be a structural break from the past in terms of making budgets in India.
So what you're saying is that if the revenue deficit falls, even if the fiscal deficit rises, you would consider it a good budget?
Absolutely.
All right. What are you actually penciling in terms of yearly gains for the index? We've already done 9%. Is there much more to be done in 2015 in terms of gains?
Yes, our target for the Sensex remains 30,000 till March 2015 and 36,000 for March 2016. I think we're on track to achieve that. Perhaps we'll hit 30,000 earlier in March, but I guess now the target is moved on towards March 2016, and something like 18 to 20% gain for the index for the next 12 months should be on the cards, given where we are headed in terms of policy making and global liquidity.
And which would be the leaders and the laggards, say, in the Nifty?
So I would think cyclical still should hold forth, particularly financials and autos. That's where we'll see the initial gains coming through. We also have the rate cut cycle, perhaps 50, 75, 100 bips this year, which should help these rate-sensitive sectors. Industrials, again, depending on the sort of budget that I just talked about, if we are looking at significantly higher infrastructure activity, infrastructure, power, capital goods should lead the recovery. And perhaps consumer discretionary and consumer staples should be carrying on as and when we see that broader economic activity trickling down to job creation. I think the direct benefit transfers for LPG, all this will also put more money in the hands of the bottom of the pyramid consumer. So even the consumption sectors should be in good hold. So that leaves just the exporters, which is IT and pharma, which While the prospects remain good, it's not so much driven off India as an economy. So to that extent, they should perhaps see some sort of money being reallocated towards cyclicals away from IT and pharma.
Okay, just talking about that consumption theme a little bit, Pramod, you know, the valuations of some of these auto stocks like Eicher Motors, Maruti, etc. have now reached stratospheric levels. Would you still continue to buy these names or continue to be bullish on these names, or now would you churn into some other pockets?
Yeah, I mean, we recognize that some of the names are fairly rich in terms of valuations. I wouldn't want to comment on any specific stocks, but in general, I think autos, we will remain bullish because some of the sectors, given the level of penetration, particularly say passenger cars, or even in some premium two-wheelers, we see a really long growth runway. So we wouldn't really be worried so much about near-term valuations because we really haven't seen any sort of a recovery. We did see a few months of good numbers coming through last year, but we really haven't seen the sort of recovery or the structural growth story that we expect some of these sectors to deliver. So, and given the quality of the franchises, we wouldn't be in any hurry to lose a position in any of them. So we'd continue to hold most of our auto exposure. And that seems like the right thing to do.
All right, Pramod, we'll let you go on that note. Thank you for joining us and giving us your view. So that is another bullish view on the markets with a 2 to 3 year time frame. India is the place to be invested into.